And let me share the screen with you guys. Mhm. All right. Okay, here we go. Of course, this is our webinar number 18. And so most of all the materials that I prepare for you guys are just my own research. And these are just for information purposes. So remember to do your own research whenever you are making an investment. And welcome to our premium club, where we try to do this webinar every 2 weeks. Of course, if you guys are new to the webinar, I am currently a wealth advisor with iFast Global Markets based in Malaysia. I'm attached to the Johor Bahru office. And iFast is basically an entire finance platform to allow you to either trade or have an advisor like us to advise you on funds and trusts and bonds and ETF along the way for your investment. This is how our platform looks like. And since you guys know me for since the beginning, I have always stick to my investment philosophy, which is basically based on these four criteria: looking at long-term opportunity, always focusing on quality over maybe a stock valuation, and just staying calm for the ride, being trying to be contrarian throughout my different market cycle. And I myself is on a journey to really just build up a portfolio that can be considered as everlasting, meaning that a portfolio that is scalable, so that we don't have to change strategy when our portfolio reaches a certain size, and it could truly allow the magic of compounding to work. I have also started the ETF Plus portfolio within my iFast account, just to share my journey with you guys on managing this new portfolio. And this is the current stock and ETF that I have within. I try to split it between mainly the US market and Hong Kong market. But of course, I would say at the end of the day, predominantly most of the ETF will still be listed on the US market. And that's where most of my focus will be at. Okay. And this is my past portfolio that you guys should have known about. Just I've been tracking my own performance since 2008, 2007, 2008, and that's how it goes over time. So today we're gonna talk about Five Below. Five Below is basically a retailer, and there are many different retailers in the US. Five Below is one of the more unique niche retailer. And we could talk about what's happening in the business, what's the business model like, the current issue that's facing the company, and why make it a possible turnaround opportunity. We're going to look at where it can still continue to grow, but where the risk as well. Then we'll try to end the session by just looking at the numbers and making sure that the numbers tally with what the story is telling us. And I'll end off with our usual spin-off segment. So this is all about Five Below. Five Below is a company, a retailer that started from Philadelphia, and it has now expanded to the most of all US states. But I'll say mostly most of its stores are still in the East Coast area and California. Um, it has roughly about 1,600 stores now countrywide. So and it currently has a market cap of about $5 billion, with with a huge drop on its share price, right, since the beginning of the year. And that's where what we're trying to um, evaluate today, which is why there's a sharp crash, and is there a possibility that it could be a turnaround opportunity right here. So I'll maybe share a little bit why there's a crash. It crashed around more than 50% from its peak, uh, mainly because of an earnings miss. In the beginning of the year, the company missed its quarterly earnings, and that spooked investors and even caused the long-term CEO to quit the company. The CEO has been with the company for more than a decade, Joe Anderson, and after the miss in earnings, the CEO left, and the current COO took over as interim CEO. So this company is still without a permanent CEO today, and it leads to a class action suit against the company. We see this quite often, but in this case, because of the crash, a group of shareholders has grouped together and go after the company in a class action suit, saying that they have misled investors from their guidance during from their guidance from 2 quarters ago. So that's the current situation, which is why the company is very, very pessimistic right now. And what does the company actually do? So Five Below is a very, very niche retailer that focuses on young teenagers. So they say their target market is age 5 to 19. So they sell kid stuff. And this is actually founded by the person called David Schlesinger. I hope I'm not pronouncing that wrong. And Tom Valio. So this is actually the third time that David has started a business, and he failed a few times before. He first started in the 80s in a bookstore called Encore Books. That was mildly successful, and he sold the business. And then later on, he created a retailer for kids called Zenny Brainy that mainly sells toys for kids. And that company fall into bankruptcy and in 2001, and David and his staff Tom decided to try again by founding Five Below, which is an evolution of Zany Brainy. And this was his most successful venture to date. And today, uh, both of them are no longer active in the company per se, but it's more professionally run. But this has been their track record so far. So the company serve young teenagers, and they name it Five Below because most of the items are below $5. For a long time, there is actually price. All the items are below $5, but I guess during recent inflation, they do now have a section called Five Beyond, where they sell items that is above $5. Yep. So I talked about this just now a little bit on what happened and why the stock price has crashed so badly. And why the picture? Okay, it doesn't matter. It's just a picture of the store. But the target market, right now, they don't specify say boys or girls, but I'm assuming that predominantly their store would attract more the female audience. And in the website traffic, which I'm able to check, around 70% of the website traffic is coming from female audience. So you can take that as a pinch of salt, whether that's just their parents who is browsing, or they're just using their parents' phone. But that's more or less, I would say, their target market is. And they split their business into three main segments called leisure, fashion, and snacks. Within leisure, they segment it into selling sports items, which include games and toys, and then they have tech, which is just accessory of tech, like the casing of a phone, or other accessory for tech devices. And also includes media. So your books, your CDs, your music would be within the tech segment. Uh, Within that, they also have create, which is just mean art and craft items. And last part of leisure is party, all the party essentials, including your cards or the decoration for party events. So all that is parked under leisure, which takes up about 45% of their entire revenue, right? Next is fashion, which is under style, which is fashion, fashion accessory, maybe even clothings. Those will be under fashion and under fashion style. And also another one is called rooms, which are furniture decor or just items that you buy for your rooms, like pillowcase, maybe wallpaper. All those will be under rooms, and these two segments will be under fashion. That takes up about 25% of the revenue. And then the last part is snacks and seasonal. As the name suggests, is all the F&Bs, snacks and drinks, and seasonal items. So during Christmas items, Halloween item, all these will be lumped under snacks and seasonal. That is another 25% of the business. So you can see that it's quite evenly split up across all their items that they sell. But main part of their business is still done during Q4 holidays. So holiday season, of course, they also sell gift cards. So parents might buy this as a gift for their kids. The store format is quite interesting because the store format is quite big. About they say a typical store is about 9,500 square feet. That's considered almost like a mega store. And it can do up to 2 million sales a year. I beg your pardon, maybe not as big as a mega store, but it's certainly quite a big store for 10,000 square feet. And it 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 can do up to 2 million sales in the first year typically. And the entire store, including inventory and their cash in hand to run the business, only needs about 400,000 of investment. So during good times, it's a very, very good business, and it breaks every store typically break even within 1 year. So the ROI is 100%, is extremely good. And so with that formula, they already have 1,600 stores in the US, and the strategy and the plan is to grow it to 3,005 by 2023. Another 6 years to go. So previously, they plan to continue to grow at around 200 stores a year rate so that they can reach the target. But it seems that they are slowing down that a little bit now with the slowdown of the business. I'll share with you guys the numbers later. And they grow around 120 to 150 stores now going forward. They're still growing. So they're still growing the stores, but just at a much slower pace. So where are the key opportunity that I feel? I do feel that this business has a very, very good ROI. The payback is just 1 year, and if done right, if the store continue to be popular, and they can scale it, it's actually a very, very good business. And typically, this retailer they run on a close to a negative cash conversion cycle, so they don't really need a lot of cash in hand to run the business, and that's another plus point. Uh, but I feel that in current times, especially this year after they saw the slowdown in the store, their same store sales actually is not growing, is actually in decline. So it highlights a few things to me. Either they are just seeing the reversal from COVID, where people just slow down from their extreme fast spending during COVID, and people are moderating. So there's a reversal, or there's something wrong with the store, that the store is no longer that relevant, maybe it's don't no longer maybe it's getting a bit stale, and there's no more exciting things for the kids to look forward to. It's no longer attracting the new generation of kids. So these are a few hypotheses I have inside my mind. And if that's the case, then there would be a lot more revamping of the stores, of the structuring of the company, um, yeah, to see how they can turn it around. And that would all lies with the new CEO. I doubt the current COO, that is the interim CEO, would do anything drastic since he's one of the old guards. If there's truly something wrong with the direction that the company is moving into, or how the stores is being set up, I don't think it will comes to the old guard that will change it. So if they're able to hire new blood from outside to revamp the place, then it will be interesting to see what could be done. No, risk, there's actually quite a number of risks that I think about. Competition for one, it's basically a low cost retailer. I like it that it's has a very specific niche that is focusing on kids and teenagers, and so this is one of the few retailers that cater the entire place for kids and teenagers. So for someone who's just for kids, for teenagers who are looking for a place where they can be shopping by themselves, who just want to spend some of their pocket money that they have saved up, uh is actually a great place to just hang out and buy some stuff. But there's still a lot of competition from be it your Walmart, your e-commerce, other low cost retailers like Dollar Tree, Dollar General. All these are a competitor to the company. Second thing that jump out from my mind is if it is a place that focus on uh, kids customers, there is a concern on safety as a place for kids. So with the gun violence in the US, should there be an incident that happened in such a place, then I think the reputation could very, very drastically go down. Um, Especially they pride themselves as a place where the kids can go independently to shop. So that's something I think could very, very drastically challenge their reputation if something happen over there in terms of gun violence. Next is to understand whether that the drop in their same store sales is due to a cyclical change or a structural change in the business? Is it because that kids just no longer that interested in low cost item anymore, or they're becoming more focused on maybe virtual items and virtual experience and spending more time online, and there's no real need for them to go, shopping to a shopping mall to hang out with friends? Uh, so that's something to think about. But to me, I don't think that it that is to that big extreme, right? That people are no longer kids are no longer wanting to go to a physical place, but rather I am suspecting it could be something to do with their product mix no longer as relevant as before. It could be in my mind a scenario where the past CEO and the past management, because they have seen such a huge upward trend over the past 10 years, maybe grew a little bit complacent, not putting up too much effort in revamping the stores and making the stores current. And just the environment has become a little bit stale. All right, this is just a hypothesis in my mind. Plus, they have to deal with inflation, where inflation has been quite strong over the past few years, like 2 or 3 years, and because of their strategy of keeping price below $5, it it would, you know, it will gonna be eating up on their margins, both in terms on the gross margins for the items, and also uh in terms of their staff costs that they have to maintain, right? While all the staff would uh most likely have demand much higher uh compensation to balance out the inflation. So all this has led to their profit drop. Do I think this company has a moat? Well, in a very minor sense, right? I the only thing that I like about it is that it is a very interesting, unique point that they emphasize that it is a place for kids and teenagers, and the entire store concept and build up an item, everything is catered for this market. So it will feel a bit special for the target market that there is actually a store built specifically for them rather than having a kids aisle or just a small section where the parents can throw them to while the parents do the majority of the shopping. So that's pretty interesting. And for such a concept to scale to a few thousand stores in the US, they must have done something right, and they already have some scale in terms of the supply chain. But apart from that, I would say that they don't really have a very big moat in the business. So this is the financials of the company. I have the record from 2015. The ex-CEO, Joe Anderson, that just quit a quarter ago, he actually joined the company as CEO in 2014. So all this is under his tenure. And you can see that it's generally just a straight line up. Um, in terms of revenue growth since 2015, they actually been growing 20% a year. So very impressive. And in terms of the net profit, it actually grew 22 to 23% a year, even more impressive. So they're not only growing revenue, they're improving their margins as well. If we just take the last 5 years, it's still growing about 18% in revenue and 14% in profits. But I would say last few years, it's a little bit skewed, mainly coming from COVID. So it's not going to be as linear as we want it to be. And this huge jump from COVID, I think is a little bit unnatural. And we shouldn't expect such huge jump during normal times. Okay, so as a key summary, right, the company has very good ROI. It's a cash business. I like the niche positioning. It's actually still a free cash flow positive business, so that's a plus point. Um, Weaknesses is still unclear whether the entire trend is changing, that kids might no longer uh, enjoy such a place, and their low their low value item doesn't really give them any particular advantage. So especially in the times where you can buy things online, uh, there's no real IP per se for wanting to go into the store if this is just something that you can get from any e-commerce store on your fingertips. So that's something that a key weakness for the company. The threat, of course, coming from competition and also just the bombardment of information from social media and all the content that we're getting from social media. Uh, Maybe in the past, a decade ago, going to such a store might be a little bit of treasure hunting, that they give you some sense of surprise to find something new. But nowadays, it's really hard to surprise someone. Almost anything that you could think of, you have seen it first from social media or from your phone. So as a physical store, as selling low cost item, I think harder and harder to create an environment and an attraction that will truly surprise your customer. Okay, so these are the summary of their profit and revenue growth. The profit the margin we talked about just now a little bit. It's okay. Their gross is a typical of a retailer. They gross at about 35%. That has actually stayed quite constant throughout. But the operating margin has been going down. It used to be around 12%. Now it's about 7 and 8%. So they're seeing pressure on the operating margin side, mainly I would say coming from the maybe the staff costs and the supply chain and also the property rental. Okay, let's look a little bit on their valuation as well. So this getting from IFAS data. And you can see that their PE is around 18 times right now, which is well below their long-term average. Their long-term average PE could go as high as 40, 50 times, at least 20 times. So at 18 times is for this company is actually considered quite cheap. And uh, they don't give a dividend, but if you look through some other retailers, you will say that they are generally at the lower end compared to other retailers right now. Okay. The mode rating is something that I always give, just to look at the company to see that, does it truly has a moat as what Buffett explained. And the few key things that I look at are, does it have economic scale? Does it have a deep, unique branding, network effect, has special IP? They have maybe a high barrier entry due to a high startup cost. They have a control on a particular resources that nobody else has it, or they just are very good at locking in their customers in terms of switching costs. Well, I don't think this company has any. So this is a zero mode company. Um, not one of the not the one of the best kind of company that we have come across. Not definitely not your Google or your Amazon. It's not even Costco, right? Um, but what is interesting here is it could be a possible turnaround. There are a long history of good growth, and they have demonstrated that they can generate good growth. They have a business that in good times is an extremely profitable business with each store break even point at just 1 year. This is extremely good formula of spending just 400,000 and could potentially generate up to 2 million in sales in a single year, and that could basically recoup the entire startup cost of the store. So in good times, is definitely a wonderful model. It has a pretty okay balance sheet. It's a free cash flow business. The balance sheet, why I say is pretty okay, is the liability is actually quite large. They have about 1.9 billion of debt liability, and the equity is only 1.6 billion. But it actually has no debt. All the debt liability is actually long-term operating leases. So all the rental uh, obligation that they have is put under the books, which is why it makes their debt seems a bit high, seems their makes their liability seems a bit high. But generally speaking, in terms of operationally, it's quite okay. Um, they 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 are able to cover the rental, and it has been generating good free cash flow year on year. and they have actually been started to do a buyback program as well over last year, and that should continue as especially now with the stock price below up 50% from the peak. But all this, I think we'd have to come down to under to see the direction of the new CEO. I think this kind of business is something that you you need a good CEO and someone with the direction to push it forward. So this is not the kind of business that Buffett say that is so simple that even idiots can run it. Uh, this kind of company, I think they need a very, very good executor and manager, in part because it's in a very, very competitive market and they're trading things that is not that all that unique. Uh, I would suspect, most of the things are things that you can find on AliExpress. Um, so all these things would need uh would need a very, very good CEO to restructure how the company should move forward. And a lot is riding on how well the plan is, number one, and also how well the execution is. So at today's valuation, I think still pretty okay. But if it becomes cheaper and cheaper, it would be even better. But I will see that even if we want to invest in such a possible turnaround, it is something of a 2 or 3 years time frame for us to look into. You know, most likely there's two ways to do it. Either we go in blind right now if you feel the valuation is good and hope that they will get a good CEO and what will come out of it. Or number two, you wait for the announcement of the new CEO and evaluate whether you have confidence in that guy or girl. And it will still need a turnaround work period of 2 or 3 years. And that's when you have to reevaluate again to see that whether you feel the company has done the turnaround or it's just treading water and nothing much has changed. And at which point, I think you have to ask yourself whether you want to just cut loss and move on. So this is definitely not a kind of companies that I would buy and hold for the long term. As disclosure today, I don't own the company. Um, at the moment, I don't have plans of investing in this company, right? Because in my own strategy, it's more focusing on high quality businesses, and I think it's an interesting opportunity here, but it's just not a stock for me. But it's an interesting candidate for us to talk about and to line up the entire thought process as a case study on how to look into turnaround companies. Okay, so hope you enjoy that uh, little analysis on Five Below. If you like such a company, I think there's other retailers that you can check out also. Dollar General Corp is pretty interesting. Of course, your Walmart, Amazon, and the best of them all, which I love, which is Costco. And Costco is a stock that I own, and I think that would be much, much higher quality business. But of course, you'll see it in the valuation as well, right? Costco today trades at close to 50 times PE, whereas Five Below is trading out 18 times. Okay. Before the last segment, which is our spin-off segment, let's jump away from investment a little bit. I just want to share with you this YouTube channel that I have been binging on a lot. Because at the start of this year, I've been focusing more and more on my health as well. After at the beginning of the year, I went for a health check, and I realized that my health wasn't in that great of condition. Mainly on my cholesterol level. That's what getting old, a little bit getting old. But I was also quite confused, I would say, about health. Mainly that I have always seen myself as quite a healthy guy that exercise quite a lot and also try to eat as clean as I can, and yet the test result is not optimal. So that makes me research more and more into health and things like that. And one of the interesting concept that I found out is from this channel called Glucose Revolution, and she's a bioscientist from France, and she's basically explaining a little bit more on how uh, food that contain glucose, which is starch, and also sugary food, will affect our energy level, and especially uh, give us something called glucose spike, where we will have a burst of energy suddenly, but then once that sugar rush is over, we become very, very, very tired, right? That tends to happen to me, especially after lunchtime, where my brain works at 50% capacity. So she talked a little bit more on like some of the practical things that we can do of don't have to go to the extreme of changing our diet or anything, but just even changing the order of what kind of food that we eat first can help improve our energy level and not make it too volatile throughout the day. Interesting. I hope that if there's something that you are facing as well, you can definitely check it out. And yeah, that's roughly uh the key presentation for today. And of course, if you guys want to know more and have a chat with me a little bit more about what I do at iFast and how I'm helping my clients create a unique portfolio that is, of course, based on my philosophy, which is finding long-term opportunity, collecting high quality stocks, and also just educating and supporting each other through different market cycles, and creating a portfolio where I feel that we can truly call everlasting portfolio. So a portfolio that we don't have to trade in and out so often, and it could actually scale as our portfolio grow, especially when we're doing dollar cost averaging. Like if you are uh, someone who want to regularly save and invest, how do we scale that portfolio up? Or if we are gonna invest every month with our excess money, or even every quarter with our excess money, to build a portfolio from beginning to end, to create something that we can sleep soundly on, while we can be quite certain that it should grow over the long term. So that's what I'm doing at iFast, and it's all based on my experience over the past close to 20 years now, in understanding and researching on investing and building up portfolios. Um, and a sample one that I'm building now is my ETF plus portfolio. So if you want to know more, you can definitely reach out to me, or even if you're just looking for a brokerage that you want to have a low cost brokerage that you can use to trade on your own, you know, uh, without me interfering, or uh, uh, you can also reach out with me through my WhatsApp, or even just through my email as well. I love to chat with you guys. We can set up a one-on-one Zoom meeting to discuss further. Okay, I'll leave it. I'll leave you with this one quote today, which is by Peter Lynch, one of the greatest investor in my mind. That he said that far more money has been lost by investors trying to anticipate corrections than lost in the correction themselves. Right, I'll repeat that. Far more money has been lost by investors trying to anticipate correction than lost in the correction themselves. I find it extremely, extremely apt in current times, and also very, very true. I hope you have a great evening. And remember that I'm going to upload all this into our Premium Club website. and you can definitely view the replays at your own pace going forward. So if you have any question, feel free to stay around and chat with me on the chat box. If not, till we meet again, investively, guys.